commercial real estate will be greatly affected by the path to reopening. Jeff Olin is CEO of Vision Capital. And Jeff, I want to start just in terms of how we get there, the effect this is going to have on some of those big players, the big tenants of these retail spaces. How concerned should we be about getting there fast enough for them?
Well, clearly some of them are hanging on by strings, so I think we should all be sensitive and concerned about that. I'm not sure it dwarfs the human condition and human concern, but from a business perspective, it's critical. I mean, some of these businesses, and certainly the trends in retail, were occurring on a secular basis before this pandemic occurred. So it's just accelerating some of those trends.
What are some of the trends that you think we're going to see? I mean, one of the big questions that we've all had, and investors are trying to figure this out case by case, is, we have habits that we've developed here during lockdown. How many of them do we maintain after? Are you beginning to develop a thesis around that, about how this will change how you're investing?
Absolutely. So it depends on the real estate property sector. So there'll be winners, there'll be losers. So we touched on retail. Let's continue there. That's the obvious one. So e-commerce as a percentage of total retail sales has been increasing. It's still relatively low, certainly lower in North America than it is in the United Kingdom. This is just going to accelerate that. The damage to the mall, fashion-oriented retail, that will continue. Malls aren't going to go away. They're going to continue to transition to more activity-based entertainment, theaters, events, where they need to be a place you want to go to experience things, as opposed to just, buy that dress or buy that shirt. But some of the traditional biases, grocery store anchored shopping centers, which were perceived and had been lower risk because everybody needs to buy groceries. Well, grandma figured out in the last 6 weeks how to go online, buy groceries online, and have them delivered to her door. So is she going to really need to go out in the middle of winter, get in her car and traipse through back? And so we think the relative attraction of grocery store anchored shopping centers, well, that's not going to happen overnight, but that will be an impact. Office clearly is going to have an impact. I mean, office already. Yeah. I remember 2000, people said, are we going to ever need office space anymore? Well, that was kind of silly. Amazon and Google are some of the biggest users of office space. But there's already been a secular reduction in demand for office. What do I mean? Lawyers don't need law libraries anymore. Deloitte just built new buildings in Toronto and Montreal. They went from 300 square feet to 160 square feet per employee. So that's already in place. Now with work from home, we've seen that the CEO of Goldman Sachs and Morgan Stanley in the last 2 weeks publicly state that their workers have worked very effectively. It will impact their decision in future of how much demand for office space they need. Warren Buffett did on his annual meeting. So that's going to be an impact for sure. It's going to be offset, in our view, because the trend to lower square feet per employee, we think, is now a floor. People are going to want to have less cubicles, less open space, and this will be some floor, so office is a trade-off. And maybe lastly, industrial. I mean, industrial, on balance, we think is a winner. All the pain in retail is benefiting industrial, logistics, e-commerce related real estate. You need 3 times the amount of industrial real estate to service an e-commerce retailer as you do a store. And you couple that with the fact that we have deglobalization, in our view, will occur, that the supply chain will be coming back home. There'll be less just in time and more redundancy in the supply chain, will all benefit industrial real estate. And so that'll be a winner. Now, in the short term, the smaller industrial players that have the local floor, wall, and tile folks, they're going to suffer along with the rest of the economy. But bigger picture, longer term, the big box warehouse will be a benefit.
We saw, when you talk about some of these trends, just Bank of Montreal this week saying that up to 80% of its staff likely never to be full-time at work again. They'll do some blend of work from home. You could imagine, right, commercial real estate landlords quaking at the sound of that. Having said that, that's a slow-moving thing, right? Most of these businesses are not locked into month-to-month tenant situations. How long before we actually see it reflected in the realities of the workplace, which could involve, you could imagine, Jeff, like the sale of a building and not purchasing or building a new one. This could take a long time to get us there.
Yeah, and we'll see what really happens with Bank of Montreal over the longer term. But certainly some of it's going to be immediate. For example, the work sharing, the WeWorks. I mean, we run of long short publicly traded securities fund. We were hoping WeWork went public so we could short it. I mean, those guys are done. And they were a huge part of the absorption of office space in major centers globally. You look at the absorption, the take up, the demand for office space in New York City, a tremendous amount over the last number of years had been work sharing environments, the WeWorks, and they're going to be struggled. I have a friend of mine who's a director of a major international consulting center group. They have 22 international offices. They're all in Regis business centers, and they've indicated they're going to terminate 100% of those leases in the near term because their staff globally have been working very well from home. So some of it will be pretty quick.
How much consolidation are you expecting to see across the real estate space?
There'll be some. It's already been going on. I mean, in retail, we saw Brookfield buy GGP a few years ago. You saw in the last few months, you've seen two of the big mall players, Simon Properties and Taubman Centers. I mean, if you thought that Taubman wasn't going to be independent 5 years, I mean, if you thought they were going to merge 5 years ago, that would have been a really controversial call. I mean, they threw in the towel. They're merging with Simon. So some of that is occurring. There's still a wall of capital, of institutional capital. I mean, Blackstone said on their conference call last week they have $152 billion of dry powder to invest in properties. And so with a low interest rate environment and, you know, the biggest spread between cap rates and long-term corporate bond rates we've seen ever, there's still a demand for the cash flow that real estate provides. And those that are more challenged or have challenged balance sheets will be vulnerable. You'll see inefficiencies. We don't think it's going to happen quickly, but we think going out 6 months to 18 months, you're going to start to see that consolidation. And frankly, that's why we do what we do in Vision, because we buy real estate cheaper in the stock market than the property market, and we benefit from that kind of consolidation. When a Blackstone wants to come and buy a publicly traded REIT, I'd rather not compete with Blackstone. I'd rather sell to Blackstone, which we've done on a couple of occasions. So you're going to see it.
All right. Jeff Olin, great to have you with us. Appreciate it.
Thank you.
Jeff Olin is CEO of Vision Capital.